So we're going to start talking with holdings of less than 20%. If market prices are available, the investment is valued and reported subsequent to acquisition using the fair value method. This is the same as we've illustrated with the debt instruments, with the exception of that this absolutely does go to the unrealized holding gain or loss income account that is reported as other revenue or expenses. If there is not a readily determinable fair market value, we value and report the investment using a practicability exception. Entities report the equity investments at cost adjusted for changes in observable prices minus impairment. Entities recognize the dividends when they're received and generally recognize the gains or losses when selling the security. More often than not, we'll have acquired capital stock in another organization via the market, and that there is often a market value to go off of. Some of the situations when that may not be the case is maybe a more closely held or privately held corporation. And if we have less than 20%, then we have to enter using the practicability exception. Forgive my inability to speak today. So let's look at this. And we're going to look here at a portfolio. So when we acquired these securities, we recognized them at cost. So November 3rd, 2017, Republic Corporation purchased common stock. Common stock is voting stock of 3 companies. Each investment represented less than 20% of the interest. So we have a portfolio currently of $718,550 comprised of common stock in 3 different corporations. When we purchased it, we recognize the purchase by increasing our equity investments $718,550. Remember, this is cost plus any brokerage fees or commissions that might come into play to actually acquire the stock. And we paid out cash as $718,550. Through the course of owning the stock, we receive a cash dividend from Campbell's Soup Company in the amount of $4,200. We recognize that as dividend revenue of $4,200. Relatively straightforward and kind of what you would naturally expect just based off general entries and how we treat different entries. Republic's available for sale equity security portfolio on December 31st, 2017 has costs and fair values associated with it to determine whether or not there is an unrealized gain or loss. Remember, this unrealized gain or loss is actually related to our income because we are using the fair value method. We currently have a loss of $35,550 as the result of the difference between what we paid for these stocks and what they are currently trading for in the market. We're going to prepare the entry the Republic would make on December 31st to record that loss. We would recognize to the unrealized holding gain or loss income statement account $35,550. And we would reduce our balance sheet holdings by $35,550 to the fair value adjustment account. The really important thing is to remember whether you were using the equity account or the income account titled unrealized holding gain or loss. If you use the wrong one, then you are going to be completely misrepresenting the nature of the investment. So we've looked at what we do at acquisition. We've seen what happens with dividends. We've done a fair value adjustment. Let's look at what happens on January 23rd, 2018, when Republic sells all of Northwest Industries common stock, receiving net proceeds of $287,220. We received $287,220 against the cost of $259,700, representing a gain on the sale of the stock of $27,520. We recognize the receipt of cash. We reduce our equity investments by the $259,700 that the Northwest shares cost us. And then we recognize a gain on the sale of investments of $27,520. On February 10th, 2018, Republic purchased 20,000 shares of Continental Trucking at a price of $12.75 per share, plus brokerage commissions of $1,850. This brings their total cost to $256,850. We add them to the portfolio for 2018. You see here on December 31st, 2018, we recognize and calculate what the fair values are for the quantity of shares we have at current market value, and then calculate whether or not we have an unrealized gain or loss from the cost. We have a previous fair value adjustment of $35,550 in a credit. Our entire portfolio is $64,250 greater than cost. Therefore, we must make an entry to bring the $35,550 as a credit to a balance of $64,250 debits. To make that entry, we must enter a debit entry of $99,800. We prepare the entry for December 31st, 2018 by debiting the fair value adjustment account $99,800. This will bring the value on the balance sheet of the entire equity investments, both cost and adjustment, to $779,950. And recognizes an unrealized holding gain or loss to the income account, $99,800. Since we credited that account, is going to represent, in essence, income or a gain.